Welcome, everyone. Today, we are diving into one of the most crucial ideas in trading. It is called volume. Have you ever wondered why some traders always seem to know the perfect moment to enter or exit a trade? Well, by the end of this session, you will understand exactly how to use volume to do just that. You will know how to interpret volume in the market, why it matters, and how you can use it to boost your own trading strategy. Stick with me. You will want to hear this. Have you ever felt like trading is just a guessing game? Imagine having a secret tool that helps you understand exactly what is happening behind the scenes in the market. That is what volume can do for you. Alright, so let us start by defining volume in trading. When we talk about volume, we are talking about the number of shares or contracts traded during a certain time. It is basically telling you how much action is happening in the market. The more action there is, the more you understand about what is actually going on. Volume can be like your own detective tool that shows the strength or weakness of price movement. When the volume is high, it often confirms the direction of a trend. When it is low, it could mean that the trend is starting to fade and might reverse. Imagine a stock price is rising, but fewer and fewer people are trading it. This could mean that the excitement is fading and the price might be about to fall. Can you see how this kind of information could help you make better decisions? Let us expand on the chart patterns here. One of the most common chart patterns that traders use to analyze volume and price action is the head and shoulders pattern. This pattern is used to identify a reversal in trend. It consists of a peak shoulder followed by a higher peak head, and then another peak shoulder that is roughly equal to the first one. Volume plays a critical role in confirming this pattern. During the formation of the head, volume is often high, and during the second shoulder, volume tends to be lower, indicating that the trend is weakening. Once the price breaks below the neckline with high volume, it is a strong signal that a reversal is underway. Another important chart pattern is the double top or double bottom. These patterns signal a potential reversal as well. In a double top, the price forms two peaks at a similar level, and in a double bottom, it forms two lows at a similar level. Volume is key here too. When the price hits the second peak or low, lower volume indicates that the trend is losing momentum. A breakout with strong volume after these levels can confirm the reversal. Triangles are also very popular chart patterns, such as ascending, descending, and symmetrical triangles. These patterns show consolidation, where price movement gets tighter over time, leading to an eventual breakout. Volume usually declines during the formation of the triangle and then surges when the price breaks out, confirming the direction of the breakout. Lastly, let us talk about flags and pennants. These are continuation patterns that often occur after a strong price movement. A flag looks like a small rectangle sloping against the previous trend, while a pennant looks like a small symmetrical triangle. Volume typically decreases during the consolidation phase of these patterns and then increases when the breakout occurs, signaling that the trend is likely to continue. Recognizing these patterns and how volume behaves in each can give you a much clearer picture of what might happen next in the market. Let us move on and discuss how volume affects price movement. Volume and price are like partners in a dance. When volume goes up, it shows that more people are interested at those prices, and this often makes the trend even stronger. If the price suddenly moves on high volume, it means there is a lot of interest at that level. But if you see the price moving on low volume, It could mean that not many traders believe in that price move. Breakouts are also something traders love to talk about. When the price moves above a key level like resistance or falls below support, it is more meaningful if it happens on high volume. Think of it this way. If many traders are pushing the price through a key level, it is more likely to keep going. But if only a few traders are behind the move, it could just fall back quickly. Have you seen something like this in your own trading? Using volume to confirm trends can be a game changer. Think of a strong uptrend. It is confirmed when the price rises on high volume and pulls back on lower volume. If that makes sense for an uptrend, the same thing works for a downtrend. Now, let us discuss some of the key chart patterns where volume can make all the difference in confirming trends. First, consider the cup and handle pattern. This pattern looks like a rounded bottom followed by a smaller consolidation phase, which forms the handle. When the price breaks out of the handle with high volume, it is a strong confirmation that the uptrend will continue. If volume is low during the breakout, it could be a sign that the move may not be sustained. Traders use the volume spike to judge whether the buyers have enough conviction to push the price higher. Another important pattern is the rising wedge and falling wedge. A rising wedge is typically a bearish pattern where price makes higher highs and higher lows, but the volume tends to decrease as the wedge forms. This indicates weakening momentum. When the price breaks down below the wedge on increasing volume, it often signals a reversal to the downside. Conversely, a falling wedge is a bullish reversal pattern where price forms lower highs and lower lows, with declining volume during the formation. A breakout to the upside with increasing volume confirms the reversal. Another classic pattern that requires volume confirmation is the rectangle pattern. This occurs when price moves between horizontal support and resistance levels, creating a box-like shape. Volume tends to decline during the consolidation phase within the rectangle, indicating traders are waiting for the next move. When price finally breaks out of the rectangle, high volume is essential to confirm the breakout. If the volume remains low, it could mean that the breakout lacks strength and may fail. The symmetrical triangle is another pattern where volume is important. As the price coils into tighter ranges, volume usually drops. The breakout from the triangle should be accompanied by a significant increase in volume to validate the direction of the move. Without this volume confirmation, there is a greater risk of a false breakout where the price initially moves out of the triangle but then quickly reverses. Finally, let us discuss the importance of volume spikes. Volume spikes can be a powerful indicator of market sentiment. For example, during a bullish flag or bearish flag, volume will often spike in the direction of the prevailing trend before the flag forms. This initial spike is then followed by a period of lower volume consolidation. The next volume spike confirms the breakout and continuation of the trend. Observing these volume changes can help you decide whether to enter, exit, or hold your position. If the price is having trouble moving in one direction and the volume is low, that can be a sign that a reversal is coming. Imagine a stock that has been going up steadily, but suddenly it is only making tiny gains and on low volume. This could be the sign that buyers are losing interest. Could you picture how this might help you decide what to do next? Next, let us talk about how volume can help you spot price reversals. Reversals are often paired with a spike in volume. Traders rush to get in or out of their positions when they sense a change is coming. Another clue is called volume divergence. That is when price is going one way, but volume is going the other way. It could mean that the trend is running out of steam. Imagine if the price keeps going higher, but volume keeps dropping. This could mean that fewer people believe the trend will keep going, and a reversal might be near. Have you ever noticed that happening when you were trading? There are also volume-based indicators that can be super useful. One of the most well-known ones is called on-balance volume. On-balance volume, or OBV, adds volume on days the price goes up and subtracts volume on days it goes down. This helps you see if volume is flowing into or out of a stock, which can indicate the strength behind a price movement. For example, if OBV is rising while the stock price is also going up, it suggests that there is strong buying pressure. Conversely, if OBV is falling while the price is rising, it could mean that the trend is weakening. Another helpful indicator is the volume weighted average price, or VWAP. VWAP calculates the average price of a stock throughout the day, weighted by volume. It is often used as a benchmark to determine whether a stock is trading at a fair value. Traders look at VWAP to decide if they are getting a good deal when buying or selling. If the price is above VWAP, it indicates that buyers are willing to pay more, showing strength. If the price is below VWAP, it may suggest weakness or that sellers are dominating. The Money Flow Index, or MFI, is another crucial volume-based indicator. The MFI uses both price and volume data to determine if a stock is overbought or oversold. It is similar to the Relative Strength Index, but incorporates volume, making it a powerful tool to spot potential reversals. If the MFI reaches extreme levels, such as above 80 or below 20, it can signal that a reversal is near, especially if there is a divergence between the MFI and the price. Another key volume-based indicator is the Accumulation Distribution Line, or ADL. This indicator helps determine whether a stock is being accumulated or distributed. It combines price and volume to show the flow of money into or out of a security. When the ADL is rising, it means there is accumulation, and traders are buying more shares. When it is falling, it indicates distribution and suggests that traders are selling. Finally, the Chaikin Money Flow, or CMF, is another volume-based tool that can be useful for understanding market momentum. It measures the amount of money flow volume over a certain period and helps confirm the direction of a trend. A positive CMF value means buying pressure is higher, while a negative CMF indicates selling pressure. Using these volume-based indicators can help you get a clearer picture of what is happening behind price movements. They provide valuable insights that can guide your trading decisions, especially when used in combination with other tools and patterns. Have you ever tried using any of these indicators? Volume is also important when it comes to breakouts. When the price breaks through a support or resistance level with high volume, it is a sign that the move is likely to continue. But if a breakout happens on low volume, you need to be careful. It could be a fake out, meaning that the price will not hold and will just turn back around. Picture this. A stock breaks above a key resistance level on strong volume. It is a good sign that people believe the price will keep moving higher. But if the breakout is on light volume, the move might not last. How do you confirm breakouts in your own trades? Now let us discuss what happens to volume during range-bound markets. When a stock is moving sideways and traders are unsure what will happen next, volume usually goes down. This tells you that traders are sitting tight, waiting for something to happen. Range-bound markets are characterized by price oscillating between support and resistance levels without a clear trend in either direction. This kind of price movement can be challenging, but volume can provide valuable insights. When you see the volume start to rise at the edges of a range, that can be a clue that a breakout is coming. For example, if a stock is stuck in a range but the volume starts to pick up near the support or resistance level, it may mean that traders are getting ready for a bigger move. This is especially true if the price repeatedly tests the support or resistance zone and volume increases with each test. High volume near the resistance level may indicate accumulation, suggesting that buyers are preparing for an upward breakout, while increasing volume near support might indicate that sellers are gathering strength for a downward move. Another useful pattern in range-bound markets is the concept of false breakouts. Often, price will move slightly beyond a support or resistance level only to quickly return back into the range. These false breakouts are typically characterized by low volume, indicating that there is not enough conviction behind the move. When trading within a range, understanding the volume behavior can help you avoid getting trapped in these false breakouts. If a breakout is accompanied by a significant surge in volume, it is more likely to be a genuine breakout. Additionally, volume can help determine when a range-bound market is likely to persist versus when it may be ending. If volume continues to remain low and the price keeps oscillating within the range, it suggests that traders are still in a wait-and-see mode. However, if volume gradually starts to increase, it can indicate that a buildup of pressure is occurring, often leading to a significant breakout. Watching volume in these situations can help you identify when the market is transitioning from consolidation to a new trend. How do you normally handle range-bound markets in your strategy? Do you wait for the breakout, or do you prefer to trade within the range by buying at support and selling at resistance? By paying close attention to volume, you can get more clarity on whether a breakout is genuine and whether a range is likely to continue or end. Let us also talk about some common mistakes people make when using volume. One mistake is thinking volume alone will tell the whole story. While it is powerful, it should not be used by itself. Always use it with other tools or indicators to get a complete picture. Another mistake is assuming that any move on low volume is weak. Sometimes prices can keep trending even with low volume, so always make sure to see what is going on overall. For example, if a stock is moving higher on low volume, do not just assume it is going to drop. Look for other things like the overall trend or recent news that could explain the move. Have you ever found yourself making these mistakes? Volume plays a big role in different types of trading too. Let us expand on some of the key chart patterns and how volume influences trading decisions in different time frames. If you are a day trader, volume is key for finding momentum during the day. Day traders often look for specific patterns such as bull flags and pennants. Bull flags form when there is a strong upward movement followed by a consolidation phase, which forms a small downward sloping channel that resembles a flag on a pole. The volume is critical here. The initial rise should be on high volume, and the consolidation phase should see lower volume, indicating a pause. When the price breaks out of the flag with an increase in volume, it can signal the continuation of the upward move. Day traders use volume spikes as a key signal to determine when to get in or out quickly. Pennants are similar, but they form a small symmetrical triangle after a strong move, and again volume should decrease during the consolidation before spiking on the breakout. Swing traders, on the other hand, use volume to confirm trends over several days or weeks. For swing traders, recognizing patterns like the ascending triangle can be very useful. An ascending triangle forms when there is a rising support level and a horizontal resistance level. Volume is crucial in confirming the breakout from the resistance. As the price tests the resistance level multiple times, volume should increase on each approach, suggesting that buyers are gaining strength. When the breakout finally occurs, high volume is essential to confirm that the move will continue. Swing traders may also rely on double tops or double bottoms to determine potential reversals, where volume behavior gives insights into the strength of the reversal. If a double top forms, for example, and the second peak is accompanied by lower volume, it suggests that the buying pressure is weakening, signaling a potential reversal. For those trading over the longer term, volume is especially useful for confirming big breakouts or key levels. Long-term traders look for patterns such as the cup and handle or head and shoulders, where volume plays a key role in validating these patterns. For a cup and handle, the rounded bottom part of the cup should show decreasing volume, followed by an increase when forming the handle and during the breakout. The head and shoulders pattern, which signals a reversal, also requires volume confirmation. Volume typically increases during the formation of the head and decreases during the right shoulder, indicating that buying strength is waning. When the price breaks below the neckline with increasing volume, it confirms the reversal. Another pattern that longer-term traders often look at is the symmetrical triangle. In this pattern, the price makes a series of lower highs and higher lows, forming a triangle shape. Volume should decline as the triangle forms, showing a lack of consensus among traders, but once a breakout occurs, the volume should spike to confirm the direction. Without volume, a false breakout is more likely, and traders could get caught on the wrong side of the move. Additionally, falling and rising wedges are important patterns for traders of all time frames. In a falling wedge, volume should decrease as the price narrows, and an increase in volume on the breakout to the upside confirms the bullish reversal. Conversely, in a rising wedge, decreasing volume during the formation followed by a volume surge on the breakdown confirms the bearish reversal. No matter the trading style, volume is the key to understanding the conviction behind the move. When the price moves strongly with high volume, it tells you that move has staying power. When the price moves on light volume, it is often a warning sign that the trend may not be sustainable. Understanding these patterns and how volume impacts them can help you adjust your trading strategy effectively. How do you adjust your trading strategy based on how long you are planning to hold? Do you use different volume analysis techniques for different trading timeframes? Now, let us put all this into a practical example. Imagine you are watching a stock that is approaching a key resistance level. You start to see volume increasing as it gets closer to that level. Then the price breaks through with high volume. This could be a good signal to enter the trade. You keep an eye on the volume after you are in. If the stock starts to pull back, but it does so on low volume, it could mean that it is just taking a breath and you should hold. But if volume spikes during the pullback, it might be time to think about getting out. Does that sound like something you could put into your trading strategy? In conclusion, volume is a key tool that can help you confirm trends, spot reversals, and understand the strength of price movements. The more you practice with volume, the better you will become at reading the market. It is a simple but very powerful way to improve your trading decisions. So why not start using volume analysis in your trades? Remember, trading is all about stacking the odds in your favor. Volume helps you do just that. Keep learning, keep practicing, and I wish you all the best in your trading journey.